We are live. Welcome to the Deal Champs podcast. We got another amazing guest on today, the master of the markets. I like that one the most. Master of the markets, Mr. Michael Zuber. Real quick, we're going to do some quick intros and we're going to hop in everything with Zubes. My name's Stratton Brown. I made my first million in business at 25. We've been in real estate ever since I was 22, and real estate absolutely changed my life. I had zero life skills, and then now I have the ability to make money out of thin air. It's pretty cool. We have the Captain America, Mr. Dean Rogers.
I like the master of the markets because it makes me, I just got my boys. You're going to be proud of this, Strat. I don't know if I told you yet. I just got my boys into Settlers of Catan. And all my friends here that I've been telling you guys about that I moved here for, they're all big into Settlers of Catan. So I've been like taking video and pictures and sending them. Me and the boys got in 3 games this weekend. So Master of the Markets sounds like a character in the game, or like you got like the Master of the Ports or something like that. So anyways, got me excited. What's up, guys? Dean Rogers, your other co-host here. Started my career in the NFL, then transitioned to corporate, then into real estate. Been investing for the past decade now in Central California. We've done 750 deals, have an 8-figure rental portfolio. And you guys can always connect with me at deanrogers.com.
And then we have the master of hair.
Master of hair is here. This last week, this was bothering me too. I think my barber screwed me up right here. It's still a little short. So this
still not where you want it, huh?
It's not where I want it, dude. I keep eyeballing it and I can't get it to go right.
You're going to look at it the entire podcast.
It is. I can't stop staring at it. I'm going to go like this instead. I'm your other co-host, guys. Jason Pritchard. Backstory on me. Worked in corporate America for 15 years, was unhappy with my job, was unhappy with my life. We burned all of the boats, started investing in real estate full-time in late 2014. And in those last almost 11 years, we've done 550 deals. We've got a rental portfolio of about $17 million right now. And like I always say with this pod, we want to take all of our learning experience from us, from our guests, and transfer that to you guys that are listening and watching, so you can skip past all the mistakes that we made and get to your goals as fast as possible. So this should be a good one. I know Zuber is my boy, so excited to have you on the pod and share some of your knowledge, man.
And now the master of markets, Mr. Michael Zuber.
What a name. Master of Markets. That's
what a name.
Sounds like a tycoon or something.
Bro.
I appreciate that. I may have to get a t-shirt made out of that, and I'll give Stratton credit for that. But yeah, my name is Michael Zuber, corporate guy. I have an econ and MBA, so lots of schooling. But really why I'm here is because I've been studying the markets for 30 plus years. Been investing in real estate 25 plus years. Financially free at 2018, replacing 2 6-figure incomes. And have spent the last 7 years trying to help people understand what's going on in the markets around the country, around the world, in California and in Fresno specific. I was lucky enough to be at Deal Champs kicking it off this year. That video just went live on my channel. People are loving it. You gave me an opportunity to tell people that I thought 2025 was the year of the investor. Everybody else is going to get hurt in 2025, but real estate investors, if they do the work and they do it the right way, are going to have a lot of fun and a lot of success. So I appreciate the opportunity to deliver that message, and happy to go anywhere you guys want.
Zoop, when was the last time you bought something in Fresno? Because you were the most disciplined investor I know. And Jason, we talked about this, about like not doing deals and having the discipline to just move forward and keep hold to the buy box no matter what.
Yeah. I think the last thing we bought was a duplex, and I want to say that was 2021. So we flipped 55 homes, or 55 properties, I should say, anything from homes to 6-unit apartment buildings from 2018 to 23. I think we added 15 or 16 doors during that period. But the last thing in Central California we bought was a duplex, and I want to say that was 21.
Yeah.
Okay.
So why is that? 21, that was the last year it felt right to buy. Because in theory, I know you're in the position to buy more, but is it just your buy box doesn't pencil, doesn't work, you don't want more? What's your reason behind that?
No, absolutely. It's all about the numbers. I'm non-emotional. I love to add stuff every year. We did pick up a property in Vegas about a year and a half ago, so it's not like we weren't buying at all. But that said, it just, the numbers didn't make sense. And also, I was getting ready for what I thought was a lot of pain. In 2021 and 22, I called for what was coming in the commercial real estate market. And really where 80% of our wealth was made was when I took 8 single family homes and turned them into 80 units.
Mhm.
And I have been watching that opportunity come like a very slow moving train wreck. So I have been stacking cash purposefully, positioning equity and debt purposefully, so that I might take 30, 40, 50 homes and go 300, 400, 500 this time. I think the opportunity is coming. Ken McElroy is already doing it in Class A. I don't play there. I play in Class B and Class C. That stuff's still priced crazy. There's been no price discovery. So, you can argue that I got ready early, but at least I didn't get ready late, right? If you get ready late, it's a problem. So I've been eyeing an opportunity to probably double or triple our portfolio in the Central Valley via a couple of strategic moves. And I hope to have that opportunity probably early 26. So that's what I've been getting ready for.
Mike, why hasn't it happened yet? We've been talking about this since like 2021, where the writing's been on the wall. I feel like most of the debt is coming due now, and we still aren't like seeing the headlines. Why do you think
the bad deals happened in 2021. In fact, I did a video in 2021. I think it was October 8th of 2021, talking about how a $117 million building was going to be worth less than 60. And I got it right. But the problem is that deal that got done at 117 had a 3-year term. So from 21 to 24, nothing can happen. Then those deals get reevaluated, or the bank looks at it, usually have a 1-year option, right? There's 3 years plus 1 plus 1. So we're just coming up on the end of extend and pretend. I would have hoped it happened already. Again, you are seeing it in Class A, but it hasn't made it to Class B and Class C because the pain is going to be so much greater. Guys, I don't know if you know this, but I had an apartment building in a very rough part of Fresno on a street called Sylmore. It was a 13-unit building. I think I picked it up for $700. I sold it for like 1.2, something like that. It got as high as 1.35, but that building should probably only be worth 500. I mean, it's just old. It's run down. It's a horrible part of town. There's gangs driving down the streets. But when, there's a bank that's probably on the hook for $1 million, they don't want to write that down. So they're just extending and pretending. But that building and others like it will come due eventually. And it won't come due at 500. They'll come out at like 375 or something, because the building will be wrecked. The past owner probably hasn't done maintenance in 2 years. It's just been bled for cash flow. So the short answer is banks are extending and pretending, but they can't do that forever. And when it comes, the pain's just going to be so much greater. We're talking, Ken McElroy talks about a 25 to 30% haircut in Class A. That means just mathematically Class B and C are going to be 40 to 60% off. So I just keep stacking paper, keep stacking equity, keep trying to grow relationships, because when this breaks, it's going to be a go time.
Real quick,
okay.
Dean, I just want to ask you about that last part. Why do Class B and Class C go on an even bigger sale?
Well, it's just math, really. So historically speaking, apartment buildings trade on what's called a cap rate. Cap rates in Class A buildings, let's call Fresno 6.5. During the run up or the craziness in 21, 22, those 6.5s got traded at 4.5. If you have a Class A at 6.5 in Fresno, the Class B is probably 8.5, and the Class C is probably closer to 10. What happened, because everybody picked over Class A, is that Sylmore building I sold, which should have been a 9.5 or a 10, sold for sub 6. So it's just called regression to the mean, and they're just gonna, when the pain comes, it's gonna be gnarly. Equity gone, banks hurt. It's ugly.
So Zuber, you've been saying that this pain has been coming in commercial. Okay.
Mm-hmm.
So I got a 2-part question. Are you seeing any pain now hitting the markets and seeing people that have taken a big haircut and taken losses? And you're saying 2026, you feel the real pain is coming. So this year, 2025, the market's kind of, I've been using the word stuck. It just kind of feels stuck. It's kind of slow, not a lot happening in the residential space, because that's where I play. But for commercial, you think there's going to be opportunity coming in 26?
So a couple of things. So mathematically, it's a guarantee it's coming. Theoretically, the banks could decide to extend it, pretend in mass again, and make it 27. But when I do the math on a 21 deal, thinking 3 plus 1 plus 1, that gets me to 2026. And at some point, they just have to take it back. Again, I've been here before, right? I invested through the Great Recession, and housing felt it first, right? 2008, 2009, 2010, we were picking up for houses for less than 50 grand routinely. But apartment buildings didn't break till 2010, 11 because they have more equity, they have bigger loans, the owners have lawyers. It's just a different ballgame. But it's coming, right? I'm picking early 2026 probably because I'm eager and greedy. The banks could extend and mass more. But back to your point on residential, that's a whole different topic. I talked about it January of this year that 2025 was going to be the worst year of this 4-year cycle, right? If you've been in real estate brokerage, real estate agents, the last 3 years and now 4 years have sucked. Ever since Jackson Hole, where Jerome Powell said pain is coming and rates are going up, it's been a train wreck. And unfortunately, I think 2025 is going to be the worst year yet. So when you talk about the market feeling stuck, you're absolutely right. And unfortunately, it's getting worse. Right? This whole tariff thing has just crushed or just created so much uncertainty, crushed demand. Now we have rates as of yesterday over 7. I think they came in today at 6.99. We've got buyer demand disappearing. And, the only people, like I talked about at your Deal Champs event, that are going to win are real estate investors who do the work, write disrespectful offers, follow up, get creative, do creative financing, seller seconds. We're going to clean up and crush. Because again, we're not emotional, right? If not that house, we'll get the next one. But there's a lot of people that are just stuck, and it does suck right now. But I do think, again, mathematically, 26 will be better than 25, 27 will be better than 26. And the thing that people don't realize is we've been here before. From 1978 to 1981, we had the same cycle. Guess what happened? Rates went crazy. It happened again. Guys, just go back and study history. So this is going to be the worst year for transactions. People are going to be so frustrated that price isn't down double digits. But that's just how residential works. It's very price inelastic. We have people with shelter costs that is low of their lifetime. If they lost their house, they'd have to rent, which means shelter would go up. So they're going to do everything they can to stay in their home. So 2025 residential stuck seems like a good adjective to me.
So a piggyback off of 2026 commercial real estate, there being pain, there being opportunities.
Mm-hmm.
How do you see the rest of the economy reacting to that? If there's opportunity, banks are taking back these properties, pennies on the dollars for what they were acquired at.
Mm-hmm.
Do you see the rest of the economy going down and seeing a negative impact? Or is there money in the market? There's investors that are ready to pounce. The good old boys with the relationships and the resources get those deals, pennies on the dollars. The everyday person doesn't know any less. They don't know what happened. They don't see the opportunities. How do you see that going down?
Yeah, so I think you're really asking two questions. I want to separate them because I don't know that they're connected. I told people on January 20th, which was the inauguration of President Trump, to buckle up and get ready for 6 months of chaos. I had no idea what was coming, but I knew one thing for sure. President Trump, just like every other president, has about 6 months to try to force something. And of course, he went into office with the House and the Senate, so he had a little bit more wind at his sails. But why is 6 months important? Because you guys need to understand that in order for him to do anything his last 2 years, he has to win the midterm elections. So again, he was going to do all of the crazy stuff in the first 6 months. I had no idea what it was, but knew it was coming. And sure enough, Liberation Day, they come out with these reciprocal tariffs, which aren't reciprocal. And it's trade deficit nonsense. But that was just an example of trying to break things so that they can get through the first 6 months. So now the bigger question, the economy. I believe we are stuck in the mud right now. The level of uncertainty, and I've been doing this for over 30 years. I've never seen it this high. Not in 9/11, not at the dot-com crash, not at invading Kuwait, never like this. Not even the pandemic was this uncertain, which is wild for me to think about. However, the thing about uncertainty is I believe every day it's getting better. Every day is more certain than the day before, right? So it's getting more and more clarity. We're still in the tunnel. We can see a light for the first time at the end of the tunnel. And you guys don't know this, but 6 months is July 20th. July 20th is when he has to be out of the tunnel. Everything after July 20th has to be net positive and net good. So to your point, Dean, I think the second half of the year is pretty good. The tax cuts get done. The job acts get extended. bonus depreciation, all those things that real estate investors love come back. And, I think the economy is in a much stronger position Q4 than now Q2. Now to your question about next year. I think there is so much money on the system on the sidelines. By some counts, 7 trillion. I've seen as high as 9 trillion. The information flows so much better today. So you're going to see banks get to a point where they're like, dude, we got to clean up our balance sheet. They're going to what they'll probably do in many cases, instead of the old boys club, is they're probably going to sell the notes and let somebody else foreclose. That's probably how this is going to go down, right? They're going to portfolio like, hey, we've got 17 buildings in Fresno that aren't paying or undervalue. We're going to ball that up, sell it to a Wall Street firm at 77 cents on the dollar and go, I'm out. And then Wall Street guys will pick and choose which ones to keep and fire sell the others. So that's probably how we get out of this. And then the multifamily space, again, with lots of pain there, but it's not going to be enough to dent the momentum of the larger economy. It's such a small market, so few people play in it. It's not going to, it won't throw a lot of cold water on the economy. If the economy's humming like I think it will in Q4, it'll be like a fly hitting your windshield at 70 miles an hour. You'll know it was there, but it won't stop the car.
So for someone like me with a residential real estate portfolio, I have equity in most of the properties, right? Over 50% equity in the portfolio. I'm thinking to myself, does it make sense to sell off a lot of assets or a portion of assets and have sideline cash for these potential opportunities? Or is someone like me not going to even see them?
So again, I think guys like you and I will have our opportunities. We won't get the creme de la creme, the top 20, 25%. That's going to go to the guys that are wired in. But I don't know that you need to sell them, right? There's this beautiful thing in the tax code called the 1031 exchange. I would get ready to execute that. The other thing I did on my channel, oh God, it was like 2 months ago, back when rates were 6% or really close to 6%, I had on a lender who we basically had a conversation about doing a portfolio loan. So again, maybe, depending on where rates are, for me, if rates are sub 6, I'll take 10 of my houses, which I own free and clear. I'll go get a portfolio loan of $1 million and go shopping. That way I keep the assets and I have $1 million bucks. I'm not really up for paying the tax man if I can avoid it.
Zuber, let's unpack Dean's comment a little bit more, because I'm curious, like if we're all in that residential space, right? Obviously positioning yourself financially so you can pull the trigger on something is good. But then again, these opportunities a lot of times aren't just listed on MLS, right? It's like, so what is the actual work that needs to happen? Is it relationships with asset managers at banks? Is it relationships with the key handful of multifamily brokers? Is it getting like really strategic and maybe pulling a list of small multifamily they bought in 2019-20, so we know that they're probably getting ready to reset, and hammering those sellers, like people that don't own it in an LLC, it's just a mom and pop that bought it, where we know, like what do you recommend are things that people do to try to get out in front of those opportunities and really find them?
So I'll give you the 3 steps. I'll give you the 2 steps that I executed very successfully in the last cycle, and then the third one that you could do today given technology changes. So step 1, at least in Fresno, I haven't looked in a while, but back in 2010, 11, 12, when I was busy in the small multis, I was Robin Kane and a couple of other commercial brokers did 90% of the listings. I bet you, if I remember, it was like 10 or 11 guys controlled 90% of the active listings. So I tried to build relationships with all 10 or 11. I was successful in 8 out of the 11. And I just checked in with them weekly. And, I was purposeful about making those connections. Anytime I go to Fresno, I try to hang out for lunch or dinner and just to build those bridges and let them, more importantly, like even with residential, tell them your buy box, because every deal is not right for you. And the last thing they want to do is call you with something and then you say no, and they're like, well, this guy's not a player. So be sure you tell them what you're looking for. The second thing I would do is I would network with banks inside Fresno, which are community banks. Think 3 to 5 branches, Tri-County, Central Valley Bank, credit unions. And I guarantee you all of those people got excited with apartment buildings in 21, 22 when it was easy to do. And I would try to meet their REO or asset managers. So I had a meeting with my asset manager at one of those banks a year ago. And every time I have to go in, I have to bring my personal financial statement. I have to bring everything. It's like I'm giving him my report card. And he said, okay, great, thanks, blah, blah, blah. And we just got to chatting. And he pointed at his desk at a manila folder, which was about an inch thick. And he said, all of those people in that file, we can only renew half of those. The other 50%, we can't renew. They're going to be forced to refi or sell. So this is coming, right? Bank liquidity is a problem. So again, network. And then the third one that I would do today, because all three of you are professionals, is I would absolutely do what Jason you highlighted. I would start setting up a drip campaign right now, 5 to 50 units. It's kind of where I'm comfortable. And I would start mailing those folks. The problem is a lot of them you got to get the bank involved. If Class B and Class C are as bad as I think they are, the sellers have no power, right? If you bought it at 500 and you put 100K in, but it's worth 350 today, you're effed already. It doesn't matter what you say. You got to get the bank involved. So you just got to know that going in. But, like all things, if you're the first person to have that conversation, you might get the bank involved and get the bank to say yes. The other thing I would tell you about banks, and I did this twice in the last cycle, is I got banks to finance me 100%, nothing down at below market interest rates because I was solving a problem for them. In both cases, I had to move money to that bank, but that's not a big deal for any of us. And, I still have those buildings today, and they're some of my biggest cash flow buildings today. So the pain's coming, and you guys have the success and track record in residential, which is harder, just so many of them. I bet you if you did a buy box for multifamily in Fresno, I bet you it's less than 100, maybe 200 that you set up on a, every 2-week drip campaign and just see what happens.
Mike, everybody talks about how there's no liquidity in the market because of like M&A and stuff, and how how does that affect the economy? Because like private equity companies, like they can't raise any money from anybody. There is no merger. So like all the big funds, they can't raise any money. So like, how does that affect the overall economy in the markets?
Yeah. Wealth effect goes positive and negative. And what we all experienced from was just the positive side of the wealth effect. Everybody was feeling rich and money was very free. The last year or so, we've seen the reverse, and a lot of people are in investments, private equity. I mean, do you guys have any idea how much this pain is coming to LPs that invested in multifamily? I mean, Brandon Turner, right? The man, myth, the legend was on my show the other day, and he said 2 of the 3 syndications he's an LP in. So he's not the GP, he's the LP. 2 of the 3 are going to zero, and the other one might be worth 50 cents.
Oh my God.
Ouch.
So you guys wonder why
That's
why there's nobody raising money is because everybody who is in is getting fucked. So, there's that. You got to get a whole new cycle. But what I want you guys to hear from this is that means opportunity. When there's money flush in the systems, you got to pay more.
Yeah.
When there's no money in the system or no liquidity, as you're asking, it means I can pay less. I can get more creative. Right? This is when deals of the lifetime are done, when everybody's afraid. And I've been through this market twice. This is my 3rd time. I love it because, again, everybody's afraid, and I'm like, let's go.
As we're coming out and like we're going on this downward trend that's going to happen, right? What do people do, Zuber, to mitigate that downward risk so they don't buy it at a point where the floor is still falling out from underneath them? You know what I'm saying? So then that way they don't hey, I think this is a good deal. And you wake up a year later and the market is still going, right? Like, what's some tips to mitigate that risk?
There's 2 things you should do. One, at the point of purchase. A lot of people, and I've warned plenty of investors. Jason, you and I've talked about this on my show. Adrian, I just talked to Ryan Pineda a half hour ago. I told everybody, like, you guys all have your models and you guys feel really, really good about them today. I'm like, you need to whack 5% off that, or 10%. This interest rate, this tariff nonsense, you got to be able to hold for an extra 3 months. And with the models you have today, they were built in a time where you could sell stuff in 45 days. So the first thing is you got to be an adult and just simply buy better, right? If you think you can buy this thing at $225, fuck it, buy it at $199, or don't buy it. That's being the adult in the room. Don't buy it at $225 because it would have worked yesterday. You got to buy it at $198 or $205 now because you're going to have to hold it for an extra 4 to 6 months. So the first thing is to throw your ego aside and realize today your biggest risk as an investor who does volume is carrying cost. I've seen a guy carrying like it was $10 million legit net worth go bankrupt because he refused to take a $50K loss. Don't be that guy. Buy better. Second, if you're going to be someone like me or someone like most of us with rental properties, you have to make sure it pencils day one and have 30-year fixed rate debt. Because at the end of the day, if the property still cash flows and it falls 50 grand, who the hell cares? You were going to sell it anyway. Just keep carrying it.
So I want to come back to this question because I want to get crystal clear clarity. And I see lots of comments coming through asking similar questions. So if you feel that there is commercial pain in 2026 and there's going to be a decline in that niche market, do you see it affecting residential real estate?
Not at all. Again, the market is so small in when you compare them. Fannie and Freddie are still the largest buyers of 30-year debt. Residential, like let's say the commercial market fell 40%, like I'm thinking. That's not going to, that debt is already gone. That equity is already gone. It's already been destroyed. It's not going to affect residential. It might on the edges affect some small community banks. What it's probably going to do, now that I think about this out loud, is it's probably going to force banks to merge. Because if you're a bank in Fresno, California, just for example, and you have a multifamily portfolio, which you felt really good about in 2022, that is now down 50%, your liquidity ratio probably doesn't support that. So you're going to get gobbled up by a bigger player. That's what's going to happen. So you're going to see your mortgage and your bank statements change. It's not going to affect the residential market. The 40% pain I talk about in commercial is not coming to residential.
Okay. You don't see anything, right? I see nothing stopping residential at this point. Like the math doesn't math anywhere. We talk about this a lot. There is not any sort of a crash.
I mean, you got to be really careful with statements like that, because I would argue Austin, Texas has already crashed. It's down 22% from the peak, right? So you got to be very careful with those. And I only say that, Strat, because I get eaten alive by crash bros every day. So if you're talking national median home price, and I've said this for 3 years running and have been right every year, is going to be plus or minus 1%. Guys, I've studied real estate for 50 fucking years. We got all of our appreciation in 20 and 21. The rest of the decade's going to suck. It's not going anywhere, but it's also not going down. Now, if you happen to be in a market like Austin or maybe Palm Springs for a California market where they changed the Airbnb rules and all of that could be a bloodbath. You know, that'll be a bloodbath. But Palm Springs is not big enough to affect the national housing market.
Have you seen any other markets like Austin have a rent regression? Like that's the only market that I've heard of where like rents have actually gone down. And then I don't know if that $100 million project you talked about was in Austin, that multifamily one.
Yeah. No, that was Houston. It was Houston. Okay. But yeah, but so I think rents are a little soft. Well, it's funny when you talk about rents. You have to be very careful. There's multifamily rents and then there's single family rents. And people treat them like they're the same, and they're not. So for the longest time, single family rents were up 3 to 4%, even earlier this year, while multifamilies were soft because supply was coming on market, especially in the Sun Belt, right? Arizona, Texas, Florida, the Sun Belt. That's actually now reversed. I'm actually seeing softness in single family rents, where if you look at the national numbers on apartments, they're actually going up for the first time in about a year and a half. Not a lot, less than 1%, but positive is better than negative. And that's because absorption, right? They're not building anymore. The big thing about multifamily that people are not picking up on is we just had record deliveries. I think it was last year. This year still will be a big number, but then nothing is coming behind it, right? Mm-hmm. There's no more cranes up. There's no more multifamily projects going up. We're going to have 2 or 3 years where nothing else is developed, and then rents are just going to go crazy in multifamily.
So I want to jump back into the 6 months of pain since the inauguration of Trump. I refer to the market feeling as stuck. You agreed with that. I did. And then talking about the market, maybe the second half of 2025, getting itself figured out and the engine's getting revved up. Mm-hmm. Where do you see that taking the market, right? You just got done saying that you felt since 2020, 2021, all the appreciation we're going to see over the next decade until presumably 2030, the appreciation has been seen. There's not going to be much of any gain going forward. Where do you see the market going? Is it interest rates going down, bringing the energy back to the market and bringing it back to life and transactions happening? What do you see making the market in real estate better second half of the year and maybe over 26, 27 and on?
Yeah, so let's be very clear about the answer. This is all transaction related, right? I think you guys, I mean, this is a great conversation. On Friday, we're going to get existing home sales for April. And the experts think we're going to get 4.12 million. I think we're going to get sub 4 million. I think the experts are going to be way off again, just like they were off last month. But here's the deal. I've been studying consumers for 30 years. And one thing I've learned for certain is the average consumer can only stay scared for 6 months. They just stay uncertain for 6 months, right? The average consumer could not go to the restaurants, not go on a trip, not buy a TV, not buy a new car, not buy a house for 6 months. And at the end of 6 months, assuming nothing bad has happened, they haven't lost their job, nothing like that. They just go, I got to live my life. So what we're going to see happen in the second half of the year is we're going to have a lot of that. We're going to have a lot of people go, I just got to live my life. I'm tired of being at home on the weekends. Let's go do a 3-day vacation, or let's go out to dinner. We haven't been to that steakhouse in a while. People are just going to get out of their shell. The consumer cannot stay scared forever. They can stay scared for a minute, and we're right in that now. But they can't do it forever. 6 months is the average they stay concerned for. Second, we have seen almost just day after day negative headlines out of the economy, the administration, tariff, tax, inflation. I strongly suspect you are going to see people like Scott Bessent and Howard Lutnick and even President Trump starting July 20th be rainbows and unicorns. Everything is great. Let's do this. Let's do that. Let's make this investment. Let's make that investment. Why? Because he's got to win the midterm. And then what you're going to see is the stock market will like that. And then you'll start to see the animal forces at work, right? They called Alan Greenspan called it animal spirits, I think. And that's going to come. It is so predictable. It just takes a little spark. But again, what is that going to do to real estate? I think that takes transactions from sub 4 million to like 4.3. So if you're in the business, a 10% move or 8% move in transactions, you're going to feel that. The other thing you're going to realize in the market, if you survive 25, I've told all my investors and real estate agents and mortgage brokers that 2026 is going to feel like a buffet. You're going to have so much opportunity, not because transactions explode, but because all of your competition left to become baristas at Starbucks. There's just like nobody else left. So you're going to just gorge on crab legs and filet mignon and lobster. And you're just going to get fat, dumb, and happy. But you got to get through 2025. And then I think 2026 is a net positive good year. We're in the second year of President Trump's term. He's got his tax plan. He's got the bonus depreciation. He's got no tax on tips and all these other things. And I think 26 is better than 25.
Zuber, where do you think, for residential specifically, where do you think interest rates need to come down to? Like, what's the magic number that
6.
kind of unlocks some
6.
of this? So when people see, like, the people that are like some of us, 2.5%, 3%, it's going to be hard for us to move, period. But there's a lot of people in that like 4% range where it's like, I can deal with it. So 6%, do you think is the number that unlocks the inventory from the people that are stuck on the sideline?
So I think there's two numbers that matter. One, there's people on the sidelines that have yet to buy, so they don't have the 4%. I think for them it's sub 6.5, right? I think we have evidence. If you go back and look at the chart versus transactions, about 6.5 is when people come off the sidelines. But as far as people that are currently locked in, it's sub 6, certainly 5.5. And I don't think we get to 5.5. But we could certainly go sub 6 in 26. But yeah, that's the kind of magic number.
So what do you think about all this tariff stuff and everything else? I'd love to hear like how you think about all of it.
Well, it sort of depends on what you mean by this tariff stuff.
So with the tariffs and the trade deficit and everything that he's going after.
So again, you have to ask yourself, do we believe the headlines or do we think there's 4D chess going on? Because I can see it both ways. That's how I stay in the middle, right? When you're on my channel, dude, it's the same video. I could be called a mega Trumper and whatever the opposite of that is, a never Trumper.
Leftist.
Yeah, I could be called the same person in the same video, which drives me freaking crazy. It's because I try to stay in the middle. So let's do the 4D chess move. The 4D chess move is very simple. President Trump knew he had 6 months. He has, since the 1980s, felt that the trade imbalances were unfair. He's on record, and I've seen videos of him in the 80s saying this. And he wants to go after that. Whether you can disagree or agree with it, that's not the question. The question is, he's the president and he thinks this. So a 40 chess move is you come out with a haymaker that nobody sees coming. You kick over the chessboard. You make a big noise. You make a big mess. And then you see what moves. Sounds like what he did. Mm-hmm. And, we'll see where this goes from here. Again, I think at this point, we are going to have 10% tariffs on all countries. We kind of saw that with the UK, which is really interesting. Because I don't know if you guys know this. We don't have a trade imbalance with the UK. They import more from us than we import from them. So it's kind of a weird one to get the first trade agreement with, but it is what it is. But the fact that that's 10% tells me that that's coming. So I think something that President Trump will leave office with is we have 10% tariffs across the board. And I'm not going to say that's a bad thing, right? If that helps with manufacturing or this, that, the other, albeit it is a tax. I think it's a tax that most companies could eat in profits, but that's interesting. The other one is, he's just a clown and he's just running his mouth and he's going to come in like a bull in a china shop. And then he's going to have the bond vigilantes tell him he's wrong. And then he's going to have a 90-day pause and all these things. So depending on whether you hate Trump or love Trump, you're going to come at this from other angles. Yeah. From where I sit, he is, he is going after something he cares for. Do I agree with it? Doesn't matter what I think. He's the president. I'm not. But he's definitely creating opportunities because he's scared everybody, right? Most of the consumers are scared today because not necessarily because of Trump, but because they hear tariffs and taxes and inflation and this and that and the other. And, that's where we are. But again, I think we've seen peak uncertainty on my channel. I called it a couple of weeks ago. Peak uncertainty is past. And I feel great about the call. I think every day gets better. And soon enough, the American public will forget about this. We have great ability to forget things. By July 4th, maybe August 15th, most Americans will forget we had a trade war or tariffs. It'll just be we'll be on to something else. So, it is what it is.
Do you see it wiping out a lot of the e-commerce companies? Like I've heard of some of these e-commerce companies getting like squeezed hard. And I think that's going to be very, very interesting.
Oh, for sure. I think there's a lot of companies, whether it be e-commerce or in clothing or what, a lot of small businesses. Like I was actually talking to a couple of small businesses that were on the brink of going bankrupt if they didn't get the 90-day pause with China. Yeah. They were about 6 weeks away from declaring bankruptcy because they couldn't afford to buy inventory, right? They buy this widget for $4, they sell it for $9, but now they suddenly have to buy it for $13. There's no price point where they could sell it again. So they were bleeding inventory, but the 90-day pause has given them a chance. So yeah, I do think, like if we stick with China's, I think it's 35% tariff right now, 10% plus the 25% for drugs. I think that's enough to have some pain, but it won't be anything like because we basically had an embargo with China. People call it a tariff. It was an embargo. We weren't selling, they weren't buying. It was on the cusp of being something pretty ugly.
During this kind of economy cycle we're going through right now, things feel a little stuck. Do you look outside of real estate for other investment opportunities? Do you dabble in anything else? Right? We talk about Bitcoin. Bitcoin's super hot topic right now in the headlines a lot. Has gone up a lot. A lot of people have made money from it that have invested at the right time. You've got your hard assets, gold and other metals and stuff like that. Do you personally look at any of that? Do you care about it? Or nope, real estate's the truth. That's the way that I stay focused and I don't look at the shiny objects.
So again, I'm remarkably disciplined, as all three of you know. So real estate is everything for me. But that said, I did make some strategic choices. In 2018, I took 1% of my net worth, put it in Bitcoin, Ethereum, and a couple other shit coins that went to zero. But Ethereum and Bitcoin have done extremely well for me. So I have that. And again, that wasn't an investment. I call that an insurance policy, right? If it went to zero, who cares? If it went up, who cares? And Bitcoin's up like 500% from when I bought it. But I'm not selling. Right? It's just, I have more than one coin and it is what it is. That said, in the last gosh, 6 months or so where I haven't done any real estate transactions. I have been in and out of the stock market at some at least maybe small levels for me, maybe big levels for others, on storage stocks. Like, for example, I bought Tesla when Timmy Waltz from Minnesota came out and talked shit about Tesla. So I went out and bought a bunch of stock at 234. It's up over $100 a share now. When the Vietnam tariffs came out, I went out and bought a shit ton of Nike because I'm like, Nike doesn't give a shit. If the shoe costs $17 to make in Vietnam and now it costs $27, who the fuck cares? Right? They sell them for $200. So I have moved some money in and out of the stock market when I think the public gets too scared or buys into the story too much. But yeah, real estate's my thing, obviously.
So how much do you really play into that? Because I see some friends, right? I'm going back to COVID when freaking the market dropped in airlines and different other things like that that were truly affected. They bought a lot and they saw the jump when everything opened back up and they sold and did really well. Do you pay attention to trends like that and try to jump on it?
So I certainly take advantage of one-off black swan events. Like I remember, I think it was Chipotle 3 or 4 years ago had a couple of bad runs with some food poisoning or whatever.
Right.
And their stock was hammered. And you know, I make moves occasionally like that. I call them storage stocks because again, once the story gets going, momentum builds, shorts come out, and you know, sure the stock can go to zero, they go bankrupt, or the bad news is going to flip. So I certainly make moves, decent sized moves in stocks like that. I don't know, once a year maybe, but it's not really an investment. It's a storage stock. And then I'll sell. I never hold long enough. I just like take my money and go, okay, great. Doubled it. You know, that's enough.
Yeah.
Let's move on.
Get out of the house.
Yeah, I'm done. I got my bag. I'm going to leave now before the bag goes anywhere else.
Mike, when you said you were raising debt, are you going to start a fund? I still think you'd crush with a fund. I think you.
We've had that conversation.
Amazing operator. You'd raise so much money, but you're a little bit of a different phase in your life than I am of mine. So, like when you say raising debt, what does that mean?
So what it meant when I said that is I was going to again take, you know, let's say Olivia and I had $20 million in equity, just making up a number. You know, I might go to somebody, a lender that I actually talk to them and say, hey, let me go get 5 million of that, right? You could wrap my whole portfolio, you know, fine LTV, you know, charge me 7% or whatever you want to charge me, and let me go ham with that 5 million. That's what I meant when I made that statement. But back to your question, I've thought about it a bunch. Like if this goes the way it could, and I get the opportunity to perhaps take down 500, 1,000 units, I would probably not be opposed, because I've talked to enough people over the last several years of having this channel and this mantra that raising the money wouldn't be that hard, I don't think. And running it would probably be a lot of fun. But I'd only do it for a short time, right? I'm on the other side. Like all three of you are just puppies, right? I'm over 50. I'm 53, and you know I'm enjoying my life, and I have a pretty good life.
Do you have another big run in you, dude? I mean, I feel like with the upcoming like opportunity that's there, the platform that you have,
one
and
more,
like,
sub 10% body fat.
If somebody came with like 500 units,
energy,
you could like snap your finger and raise all the money that you need, dude. You know what I mean? And do it. I feel like you got one more.
One more.
A sub 10% body fat gave him the new energy, man.
That's right. Yeah, no, I honestly think I got one more in me. By 2030, though, I want to be done. I'll be out of daily grind.
So Zuber, you said you would maybe do it for a short time. What does that look like? As a short time, I raise the funds, I buy the assets, I maintain and keep the assets, keep the investors in it. That was part of the plan all along. Or I refinance, exit out the investors and sail off into the sunset. Is that the short time I acquire at the right time and then I just set it and forget it?
Everything I would do would be above board. It would be a 5 to 10 year hold. We would be out entirely in no later than 10 years and as early as 5 years. And I wouldn't do the refi game. I would basically take everybody along with me for the ride. We'd share in the spoils equally. and we would sell and be out. It would be that last kind of celebration. I know there's a bunch of syndicators that do that. They raise money, then they refi people out. I'm like, that's not fair. Yeah, you got the money, you got the return, but you're going to eat the most, and I just can't stomach that. So I would take everybody along for the full journey and, you know, pop that cork at the end of somewhere between 5 and 10 years.
Mike, when you say you'd be done, I can't imagine you ever really being done, just personally and knowing you.
Yeah, no, I got to define done. Yeah.
To where Terry's like, yeah, bro, we could sell off, because he has a big portfolio. He's like, we've tried selling off tranches and throwing it into the market just to give us returns. And that way I'm not thinking about it. But from my understanding, your real estate business is pretty passive for you.
Oh,
so
yeah.
Like, what does done look like?
I guess done for me would be, because I still look at my market every day. You know, you guys think this buy box thing I talk about is just for everybody else. I still look at it every day. Now I have 2 buy boxes, Fresno and Henderson, Nevada. So the grind would definitely, I think, like, I like to buy something every year. That's kind of my goal, is to buy something every year. I think by the time, because again, you got to remember, right? By then I'm almost 60, and I think it will be much more. I think I guess at 60, done means for me is I'm starting to put the portfolio together so that I can hand it off to my daughter. What does that mean? It probably means I sell my dogs, right? We all have stuff in our portfolio like, this is too much. This is too much work. Wrong part of town. Too old. Whatever it is. So probably that is when I start getting serious about, okay, which ones do we let go? Which ones do we pay off? Because my goal is to hand my daughter a portfolio of free and clear properties, so she's got nothing to worry about. And we're obviously not close to that now. So that's probably what done means to me, is less acquisitions and more portfolio purposeful management, if that makes sense.
Since you're a little bit further along that path than us,
yes, I'm older. I'm older than you. Yes,
that was the choosing politically correct verbiage there. So, what does that conversation look like? I'm actually curious, man, because I think, we all have kids kind of in different age groups, right? You know what I mean? Dean and Strat's kids are a little bit younger. Mine are a little bit older. Yours are a little bit older. So, what does I think all of us have a similar vision too. Like, we want to hand something, to our kids. We want to create a legacy that we can pass forward, right? Like, for you, how do you have conversations with your daughter and be like, hey, like, this is what the trust is like, and this is how things work, and this is how in depth do you get with all of that?
And what gave you the confidence to pass it off, Mike? That's another thing that is terrifying.
So all of these are great questions. And make sure we get to all of them because they're multifaceted. So first off, let's put some ages on this, right? My daughter's 33, almost 34. So she's older than, she's an adult, right? She's a tax-paying citizen. So you can have real conversations with her. And I suggest having the conversations, we try to get together every Christmas. Either she comes home or we go to wherever she is. And I just make sure to have this conversation because you just never, stuff changes, right? As they grow up, or, she's been in she's in a relationship. She's all, she's a young woman. So I just make sure that what she wants. And at least until this point, she wants nothing to do with our portfolio. So what I have to do is write up, kind of a trust and a will and, all of those things that basically says, these are the properties to keep. Here's the manager, right? You guys know the guy I use. And here's his number. And, I recommend you keep these. And if you want to sell these, sell those. And, if you have any questions, here's your guy. Because you got to make sure it's easy for him. And you also can't force anything. One of the things that I did absolutely wrong when Teresa was a teenager is we brought her to projects on the wrong freaking day. We brought her to the projects that were old and disgusting. I remember opening a house that we still own and seeing cockroaches fall from the ceiling. Yeah. Like, just disgusting. I should have brought her.
Those are the best ones.
That's what I thought, but that's not what she remembers. She still remembers the roach house. And anyways, bad dreams and nightmares happened after that. So don't do that. Bring them to the pretty ones, the ones that smell good. Also, do a better job of connecting experiences with real estate. So, for example, we went on a Mediterranean cruise. It was one of the spoils we did when I think she turned 16. And I should have done a better job of saying, what paid for this? What paid for this lifetime of memories? Real estate. And I should have had conversations about that. I tried to shield her from that, and I shouldn't have. You should bring them along. And hopefully you guys are lucky enough that one of your kids or multiple of them want to do real estate. I could not imagine what that feels like. I was not lucky enough in that situation to have that. But if you're lucky enough to have that, dude, hold on to that, because that's a gift.
Tying it back to the experience is like some of the best advice that I've ever heard you give, dude, because then it's like we do it for a different reason. But when you can say like, this is what unlocked this really cool experience, this was the bridge that got us there, I think it impacts in a completely different way.
Yeah, and it could be time too. It could be time, right? All of you have the flexibility, right? How many dads could be off at noon to coach their basketball game, or be the the parent that goes on the overnight trip or something?
Yep.
Right. Make that connection.
I love
they
that.
need to know. They need to know what's going on.
I like that point, especially. My parents did a phenomenal job raising me in so many different ways. The one thing that they did, I wish they would have done differently, and I'm doing differently with my kids, is not shield or protect me from how much money they have or don't have, right? What is a lot of money? What isn't a lot of money, right? Mm-hmm. We just went on this family trip to Europe, right?
Yeah.
Me growing up as a kid, what allowed that to happen, and how much did it cost? Right?
Yeah.
We just spent tens of thousands of dollars. That's what it takes to be able to experience this. So they our upbringings were very humble and was very kind of sheltered and guarded from that, which is good. It's made me very humble, and I'm very frugal. But at the same time, it took me a while to figure out how much money was needed for this and for that.
I would strongly suggest there's two things that I would do different if I could be a dad, like raise Teresa again. There are two mistakes I make that I still carry as disappointments. One is I didn't hug her enough, right? When you have a daughter, you have a very small window where you're everything to her, and to get those hugs, right? I never had a son. I assume it's the same, but I don't know for sure. Never had one. But there's this, and then at some point, for me, it was around 13, they get batshit crazy. And you forget getting a hug. If you're outside anywhere, you're not getting a hug. Maybe you'll get one inside, but that's it. So I wish I hugged her more. But to your point, the second one is we should have talked about money more. Right? She saw us go from having nothing to having more than enough. Right? I could only imagine how that would have transitioned for her and what she would carry forward now, because frankly, she's 33 now, and she doesn't really care about money, which is kind of like disappointing to me, because money is everything to me growing up. But it's because she's been comfort. I never told her about the hard days and the this and that. So it was a miss. So don't do that.
It's crazy, dude. Listen to this experience. So our younger son, we were just visiting with him last weekend, and he's in a really good spot right now. When we were talking about some of this transition that we've gone through, and he actually said, Strat, you've been there. I don't know, Dean, if you've been there. Remember the house that I was living at before the house that I'm in now, where we used to go play basketball at? When we sold our house to move in there, it was like this dope thing for me and Jen. I was like, man, dude, this is it. He was pissed about it, dude. He was like, why did we move to this house? Like, this is too much. We don't need all of this. I don't care about a swimming pool. I don't care. And it's just like, to your point, you don't, like, you're not I know for me, a mistake, I was so focused and so ingrained in, like, it's all like just grow. And you just don't take the time in those moments, dude, to really think about, like, how is this impacting your kid? Who cares what you think? Who cares how much money you're making? You're not even thinking about, like, the impact that it has on your kids, dude. And that conversation I had this weekend reminded me that that's another really good lesson. And you guys still have time because your kids are young, dude.
Yeah, dude, I as a dad, if you're lucky enough to have daughters, hug them more. I assume that applies to sons. I don't have that experience, but just hug your kids more. They need to know that dad loves them, and there's nothing like that physical connection. And then please talk about money more, the good and the bad.
Totally.
Those are misses I had.
I wish my parents would have told me, like, how much is a lot of money. Like, because it's taken us a long time to comprehend, and like it grows with time. The way Warren Buffett talks about money is the difference than what we talk about. But then, Dean, telling your kids, like, no, this cost us tens and tens of thousands, and this is the amount of output that had to go into this, and this is why we push you to do certain opportunities.
You know what?
That's the only way you're going to get it.
one of the things I would do with kids today, and I actually talk about this in a thing I call "Get Your Money Right," is kids don't comprehend dollar amount, but they do comprehend time. So I suggest all parents get out a piece of paper and do the following, right? All of you probably know how much money you make. I'm just going to make up a number, 50 grand. All of you probably know what you net. Let's call it 45 grand because 5 grand goes to taxes. Or let's say it's 48 grand, just so the math is easier. So that's 4 grand a month, right? 4 times 12 is 48. Now, 4 grand a month, that's before expenses. You still have mortgage, food, car, auto, health, blah, 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 blah. Let's say at the end of the day, you are left with $500 in what I call discretionary income. Okay? For some of you, that number is 0 and you're in trouble. But let's pretend today it's 500. Then your kid comes to you and they want these $5,000 shoes, right? You and I would laugh at that, but they don't know any difference. Maybe they got rich friends or whatever. So something you could do is you can convert that into time, right? And say that, hey, mom and dad will have to work for, in my earlier example, what would that be? 10 months to afford these because you only have 500 months discretionary. And this is clearly a discretionary item. Do you think it's worth mom and dad working for 10 months to buy these? Most kids will look at that, go, no, I'd rather have mom and dad at home than do that. So I think more people need to convert stuff to time. And you do that by taking discretionary income and divided by your hourly work week. That's all you get to play with. All these people, like I know people in Silicon Valley that make 6 figures, multiple 6 figures. They got no 2 cents to move to get, rub together. They have no discretionary income. The whole path to getting wealthy is, we talked about this at Deal Champs, is you have to create discretionary income, then become elite, and then do it for a freaking decade. It's not that hard.
Dude.
But,
Preach.
That's all it is.
Yeah.
It's the doing it for a decade thing.
That's
where
right
people
there.
fall down.
Yeah.
I love that
I'd
so
say
much.
that is the biggest thing. I had another. Mike, how do you think AI is going to affect the markets over the next 10 years?
Oh,
I
AI.
think that far out.
Oh yeah, absolutely. Yeah. So again, I'm old enough to remember when the web was going to destroy all our jobs. So I think AI is going to be net a positive. What do I mean by that? I think more jobs will be created than lost, but there'll be entire sectors of the industry that are destroyed because of AI. They just won't exist anymore. But on net, I think AI creates more jobs than we lose. I also think AI is going to allow a lot more entrepreneurs. Like the thing that the 3 of you do that I've never done is be an entrepreneur. I think the next generation, right? You guys minus 10 years, minus 12 years, they're going to be starting companies and growing exponentially fast, right? Because where you had to outsource and get bodies and, VAs and all of that, they're just going to turn on different AI chatbots or whatever the hell they're going to be. And you're going to see 10, 50, $100 million companies with less than 5 real employees. I think it's going to be amazing to watch.
I believe that. So you mentioned something earlier that stuck with me, and I'm curious. I wanted to ask this question earlier, and it came full circle. You said you were comfortable with 5 to 50 units. Okay.
Mm-hmm.
And then you talked about potentially, what if for a short time you went and bought 500 to 1,000 units? What would be your path to get there? Would it be more 5 to 50 units and just a lot of it? Or would you ever consider going into the 100 unit, 200 unit, 300 unit complexes? Is that ever interested you? Or is there a good reason you've maybe stayed out of it?
I like buying from mom and pop landlords. That's where I have my fun. That's where I feel like I have a unique competitive advantage. When you're going in and trying to buy 300, 400, 500 unit buildings, you're typically dealing with Wall Street or a professional firm.
Totally.
That's why I don't go there. It's just a different animal. And I would much rather deal with an owner versus some Wall Street lawyer.
And I don't know how they make spreads on those like bigger deals too, because they're savvy too. Is my thing. Like,
yeah.
So like, where's your spread that you're gonna make? Because they're still savvy. They're operators.
I would feel like I'm missing something. Absolutely correct. Yeah. I would feel they're going to get me somewhere, and I'd be like, nah, too hard, pass, move on.
Yeah.
Yeah, that's exactly how I'd feel with any of those things. All right. Dean, did you have anything else? Jason, did you have anything else? We're kind of running up on
this
time.
was
awesome.
This was ran the gamut, dude.
So
the market, how to raise your kids, dude. AI, everything, dude. This was great.
Zoobs, are you going to go to the All-In Summit this year?
The All-In Summit? No. Nah.
No.
I've
We've
actually,
talked about maybe doing it.
Me and
Yeah?
Jason were thinking about going this year.
We've talked
yeah,
about
that would be, I think the All In podcast is the one that I listen to each and every week. I think it's gone downhill since
Same.
David Sachs left. It's more of Jason just whining and crying. It just drives me crazy. I like Chamath, although he's getting a little high on himself as well. I don't know. I never thought about going to it. It would be interesting, not necessarily because of the speakers, but just who else is in the room.
Yeah.
Like those
Very good room, bro.
those ticket prices are a great gatekeeper. You're not getting any slouches in that room. Like $5
They're
grand a
doing
ticket or
something
whatever it
in
is.
Vegas for F1. Maybe we'll do a F1 trip. Come to your
Are they?
backyard, dude.
Yeah.
They're doing the
Are they?
Vegas F1. They're doing something, dude. Maybe we'll.
Yeah, they're
convince
playing
you.
poker or something. Yeah.
Yeah. I heard him announce it on the
I'm
last
doing
episode.
Austin, Texas F1 with my two oldest boys and my dad this year. So
Hell
Good
yeah,
for
dude.
you.
that'll be
That'll be
fun.
good.
Make
There
those
it is.
memories.
Tie it to the experience, bro. Yeah, that's
Yep.
right.
That's right.
Awesome. Well, Mike, if we go, you got to come with us. It's 10 grand a ticket at this point. It's 10 grand a ticket. That's the best room I think I could go into right now. Like
I
that's
love
a
it.
solid room.
Yeah.
Guys,
So real quick. So on that topic, right? One of the things that I think about when dropping 10 grand is what's my return going to be? I just can't get away from that. The three of you have an easy answer for that. What do I need from that room? Right. So that's why I probably don't.
What do you think?
Got
our
one
easy
more
answer is?
big run in you, Zuber. This is
Yeah,
it.
you got one more
This is
big
what
run,
your
bro.
10 is. This is the start of the big run in Zuber, dude. That's it. The 5-year
That's
run.
exactly
That would. Yeah.
We're
That's
stoking
a
your
fair,
fires, man. We're stoking your
fair
fires.
point. Fair point. Oh, that's hilarious. Good job.
I love it. Guys, thank you so much for tuning in. Don't forget to hit like and subscribe. Mike, the master of markets, thank you
Heck yeah.
so much for coming on and dropping so much value with the Deal Champs community.
Of
Great
course,
podcast.
anytime.
Great job.
Later.
See you guys soon.